ETF Insights is brought to you by Amova Asset Management. Your goals, our commitment.
Welcome, investors. This is ETF Insights. I'm Michelle Martin. In a declining rate environment, how can a bond ETF work for you? You should always understand instruments that can help you meet your financial goals. And today, I'm taking an exclusive look at the ABF Singapore Bond Index Fund with Bertram Sarmago, Investment Director and Portfolio Manager at Amova Asset Management Asia Limited. Bertram, how are you? Good morning.
Hi, Michelle. Good morning, everyone. Thanks for having us here.
So, Bertram, I understand the ABF Singapore Bond Index Fund, if we take a historical perspective, this was the first SGD-denominated Singapore government bond ETF to launch in Singapore in 2005. It's 2025, so what's changed?
So this fund was an initiative of the governments in Asia. It's part of the regional initiative to develop local currency bonds in the region. During the time of that launch, this was under DBS Asset Management. And in 2011, it was under Nico Asset Management. And this year, this is now, and we have renamed to Amova Asset Management. And this is still the same Singapore government bond ETF that was launched in 2005.
All right, name change, but it's the same familiar ETF. Let's dig a little deeper into what this term refers to. What is the ABF Singapore Bond Index Fund?
Yes, so it's an ETF. It's an exchange-traded fund that trades in the Singapore exchange. So it invests in government dollar bonds and other government-related entities like HDB, LTA, and Temasek. So the index may include other government-related entities if they are issuing in Singapore dollars. And you get a basket of bonds issued in this market from 1 year to as long as 50 years. If you look at the top 10 holdings of this bond ETF, it's all Singapore government bonds maturing from 2026 to 2072. And so if you look at the issuer weights, around 83% is Singapore government bonds, HDB close to 11%, LTA around 5%, and Temasek, which is a government-related bond issuer in Singapore, around 1.3%.
Wonderful, familiar names there. For investors tuning in, the natural question, though, is if I put money into the Amova AM ABF, what kind of yields or payouts can I expect?
So in terms of yields, so when you buy a bond, you get a yield, right? So currently, the average yield of all the bonds in the ETF is close to 2%. So in general, historically, in the past, that's the yield range of government bonds in Singapore from around 2 to 2.5%. And so in terms of dividends, for example, the dividend payout for this fund is twice a year. So for example, in January, the fund paid out 0.013 per unit. And in July, around the same size. If you divide that by the NAV or the price of the ETF, the latest distribution yield for this year is around 2.2%. So that is sort of like a range of the dividend yields that this fund can give, which is more or less close to what government bond yields is being given currently.
How should investors think about a bond ETF compared to holding SG bonds directly?
Okay, so holding a Singapore bond directly, you just have, let's say, one bond, and that can be a 5-year bond or a 2-year bond, and that will have fixed maturity. So as the bond goes into season, like 2 years after, it will have lower duration. Or if you bought a 5-year bond 5 years ago, it will be close to maturity. It's almost similar to buying a 6-month T-bill. But for a bond ETF, the maturity is more or less stable because we are matching the maturity against that of the index. So on average, you're always holding the underlying government bonds and HDB bonds in the market. So more or less, the maturity is stable throughout the years. It just depends on market issuance by the government. So on average, the average maturity is around, let's say, around 5 to 10 years. The duration, which is a measure of bond index maturity, is around 8 to 9 years currently. So that is sort of like the duration that you get when buying the ABF bond ETF.
Yeah, with rates expected to decline, what do investors need to know about the ABF Singapore Bond Index Fund's duration as they consider, potential bond price gains?
Yes. So when interest rates are going down, we know that bonds appreciate in terms of price or in terms of capital. So in an environment where interest rates are going down, we do expect price appreciation from bonds. So the ETF itself is expected to appreciate in terms of price. So for example, in the last 1 year, bond yields has been declining. And so aside from the bond coupons that's been receiving from the bonds that we invest in, the prices of the bonds has been going up because of interest rates going down. And so in the last 1 year, for example, ending August, the ETF has returned around 9.9% because yields has been going down quite strongly in the last 1 year. And so with interest rates still heading downwards or at least stable, we think that bonds will still, the ETF itself will still be performing well in the next few months or a year or so.
Bertram, for income-focused investors, what does a bond ETF offer over Singapore savings bonds or fixed deposits?
So one first is that between Singapore savings bond is more or less just a 10-year bond that you buy into. It's more or less accessible to most retail investors with certain limits. This one is more of a portfolio of bonds in the ETF. And so it has maturities from 1 year to as long as 50 years. So for investors who want to gain exposure to the market in a long term, I think this is a good asset class or vehicle because it performs to how interest rates move. So when interest rates are going down, this fund will perform well. And it's also a diversifier in the sense that this will perform well during market stress or market downturns. And we see that you see during the global financial crisis or during COVID when bonds generally perform well and will not have the higher volatility that you see in other riskier asset classes. This compared to fixed deposits is different. I would look at them as different asset classes because cash is something that you will have more or less stable value. But for bond ETFs, you are exposed to the bond price movements. And it can go up when interest rates are going down, and it can go down when interest rates are going up. So during periods where interest rates are rising or inflation is high, a bond ETF can have negative returns.
Diversify your ETF portfolio. ABF Singapore Bond Index Fund ETF. Learn more at sg.amova-am.com.
You're listening to ETF Insights. I'm Michelle Martin, speaking with Bertram Sarmago, Investment Director and Portfolio Manager at Amova Asset Management Asia Limited. If we look at the asset class of bond ETFs, what would you say are the main advantages of a bond ETF?
I think for a bond ETF, it's just for me 3 points. One, it's a vital component of a balanced portfolio. There's a classic bonds and equity combination. It's a balanced portfolio. So it's an important component of a balanced portfolio. And bond ETFs are accessible, cost efficient, daily liquidity, meaning you can buy and sell on a daily basis. Let's say for other bonds, you have to wait every 2 weeks, let's say for T-bills. And for fixed deposits, you have to wait for maturity before you can sell. For ETFs, before you can redeem. For ETFs, it's a daily liquidity thing that you can buy and sell on a daily basis. The second part is size. Size is easier to deal with ETFs because even for $1 or $10, you can buy it from the exchange and at a low amount. Whereas, for example, for T-bills, you need a minimum of 1,000, and so you have to wait every 2 weeks, 1,000 minimum. And then in terms of selling, it's much faster to sell the bond ETFs. And for investors having a long-term view, they can use an ETF as an important part of the allocation in their portfolio. And for tactical investors, they can use this when they view interest rates going down, or just to, if they are in a recession risk environment or outlook, then bonds are expected to perform better than other risk assets. So a bond ETF will be a convenient tool for tactical allocation and strategic long-term allocation.
Wow, great overview there. Is there a minimum amount I would need to park into it to get started with the Amova AM ABF?
In the exchange, with your brokers, you can buy the ETF as minimum as $1, but there are transaction costs, so it may not be as efficient. So I would have a higher amount just to cover the transaction cost of trading when you buy, similar to stocks. When you buy just $1, it will be a very high transaction cost. So bond ETFs like stocks are traded that way, and it can be as low as $1.
Fantastic. If we take a step back out again, what are some of the risks of bond ETFs? Remember, you're not buying a bond, you're buying an ETF of bonds. So what are the risks?
So primarily one is the market risk associated with buying bonds. And so the interest rate risk exposure that you get, which is measured by duration. And so this is exposed to movements of interest rates, and bond prices go up or down based on interest rate movement. And that's a probability that if interest rates go up, inflations are going higher, bond ETFs can have negative capital appreciation. The other part is more about liquidity of the bond ETF, in the sense that when you trade in the market, if the bid and offer, when you buy and sell, those are just liquidity factors. But overall, I think the primary risk for bond ETFs is the underlying interest rate risk when you buy a bond ETF. Because in the underlying part, which is credit risk, this is issued mostly by Singapore governments. So it's a AAA government. So from a credit issuer perspective, this is a high AAA quality bond ETF.
And also, in terms of capital guarantees, the difference between, say, buying a bond and a bond ETF, right?
Yeah. So in terms of capital guarantees, the underlying bonds that we hold are government bond ETFs. That's where the sort of like government credit that we're taking into. But in terms of appreciation and market movements, it's a market risk that the bond is exposed to, especially if you sell in an environment where interest rates are going higher. So there's no sort of like capital guarantee, but the underlying bonds that we hold are issued by governments and government entities.
Very good point. You touched on this earlier. I wonder if you could give us some more detail on the role a bond ETF would have in a portfolio in terms of diversification. You mentioned it's important.
Yes, so bonds behave differently from, let's say, equities. So in general, bonds have lower volatility, so and performs well during market stress. And the other part, which most investors look at in a balanced portfolio, is correlation, or do this asset class move together? So when equities are going down, bonds usually tends to perform better. So this is sort of like a diversifier in a portfolio, especially in equity-heavy portfolios, and that will improve the smoother performance of an investor's portfolio. Instead of having a high volatility, higher risk asset class, adding bonds into portfolio can smoothen out the year-on-year performance of your portfolio.
Bertram, how resilient would this bond fund ETF be in an economic downturn?
So yes, so the iBox ABF Singapore index has performed well during previous episodes of financial uncertainty, global GFC financial crisis, even during COVID. This is due to the high credit quality of the Singapore government and the Singapore government-related issuers. So Singapore is in Asia is the only one country that has the AAA credit rating from all three rating agencies. It has maintained this AAA rating in the last 20 to 30 years during the Asian financial crisis, during the global financial crisis in 2008. And in fact, Singapore government has been given a higher credit rating than, let's say, the US government. So Singapore has AAA credit rating across all rating agencies, but the US has a double A plus, which is one notch lower than the Singapore credit rating. On the other hand, you have Japan, which has a single A plus credit rating. So during an economic downturn, Singapore is considered like a safe haven asset class, given the government bonds are AAA rated.
What type of investor might be interested in a bond ETF?
I think bond ETFs will suit investors, one, who have lower risk tolerance. I mean, bonds traditionally are lower volatility asset class. And so for investors who don't have the risk appetite, then a bond ETF will be appropriate. And these are also appropriate for investors who are seeking portfolio diversification, adding bonds as a diversifier to an equity-heavy portfolio. And for investors who don't want the high volatility asset classes and still want higher returns than, let's say, fixed deposits, then bonds in general will be a better asset class, given the fact that in the long term, bonds will be expected to perform better than cash.
So finally, if one wanted to learn more about the Amova AM ABF, what could a listener do?
So for investors, the fund has a website, and they can access our website. We have all the information with regards to the bond ETF and even other bond ETFs that we have in our platform. And so providing investors with access and information like fact sheets or prospectus of the funds and the ETF, the ABF Singapore Bond Index ETF specifically.
Well, thank you so much for joining us, Bertram. It's been a real pleasure.
Thank you, Michelle. Have a good day.
That's Bertram Sarmago, Investment Director and Portfolio Manager, Amova Asset Management Asia Limited. This has been ETF Insights. I'm Michelle Martin.
ETF Insights is brought to you by Amova Asset Management. Your goals, our commitment.